what's the rate of return on that? I said, oh, it's negative. And I owned it. And the reason why that one's okay, have less of a planned balance in there is because it will help you spend more efficiently. So it depends on what the purpose is. If you're only planning for net worth, this won't make sense because you're not planning towards a particular goal, a particular target that we're managing for how much capital you need for that target. So if all you want is net worth, this stuff isn't going to make sense. If you want a particular outcome, what we do is far more efficient. It takes less money to do it, which is beautiful once the math is understood. Daryl, he is in that study group. He's taking advantage of that, so he's learning all about this from the masters himself. So I happen to know that. But yeah, government. Not only is the government taxing you along the way, they're taxing you as you're taking it out. And then if you're not taking out enough, they're going to force you to take out more because they want their taxes. And if you don't take it out, and this is a change, it used to be a 50% tax on top of what you're supposed to take out if you don't take out enough. Now it's only 25%. Oh, how generous our overlords are.
Their benevolence.
How nice they are. And of course, I'm sure we've all heard of the Nancy Pelosi story. It was the previous administration. They caused this train wreck of an economy. So we're going to waive RMD. They did it so that they can make sure that when people sold out of their holdings, they weren't selling out at a low value and having lower RMD requirements. They did it, to make sure that your account balances can go back up and they can charge taxes on a higher amount. So Daryl asked a great question. What happens to the 401k if they pass away unexpectedly? Beneficiaries also have to pay taxes first before they get any of the money. So with a 401k plan, and let's assume it's a non-spousal. Because with a spouse, I think they can just continue it. Because a non-spouse, they have to liquidate it within 10 years. There's a new 10-year liquidation rule. That's part of the Secure Act 2.0. This is what pretty much took away what they used to call the stretch IRA provisions, where you can take out minimum required distributions and have it work for generations. That is gone. Ed Slott, one of his first books was How to Parlay Your IRA into a Family Fortune. Yeah, that's gone now. Forget that. Life insurance is far better for doing that. So if they pass away, the beneficiaries can take out distributions. And what are they usually going to do? Probably liquidate the whole thing, depending on their age and their current situation. And they're going to take it out, either a lot of it all at once or they're going to stretch it. They're probably not going to wait the full 10 years. I'm just looking at human nature and, people need more money these days. When they take it out, they will owe federal taxes and state taxes.